So many people believe that mortgage forbearance ending is going to be the start of the next housing crash. That, coupled with stimulus, the moratoriums on evictions and foreclosures are all come together at once and create this massive wave of foreclosures that's going to hit the market at one time and essentially drop housing prices 50%. That's what people are saying on videos that I post when I talk about the housing market. And in fact, I did a survey yesterday asking whether or not people thought that mortgage forbearance ending would be the start of the next housing crash. And the majority of people said yes. Now, it wasn't an overwhelming majority. It was a little over half felt that mortgage forbearance ending would be the start of the next housing crash. So in today's video, I want to pull up the latest report from Black Knight that discusses what's happening with mortgage forbearance. How many people are actually in default? Because if you look at the media, they're telling you 3 million people plus are in default on their mortgage. But if you're allowed to miss your mortgage payment, are you actually in default? That's what I keep asking. But we're going to take a look at the numbers. How many people are actually in default? That aren't able to truly make their mortgage payments. How many people are coming out of mortgage forbearance and able to make their payments? Because I think that's important. Which states are, have the highest delinquency rates, potential foreclosures when this whole thing ends? We'll talk about which states are performing the best in this whole deal. And then we'll also take a look at which loans are performing the worst. Because if there's an area of the country that has a greater majority of these types of loans, then you could see more damage, if you will, more foreclosures in that area, actually bringing home prices down. So, we always talk about real estate being local. And, if a lot of foreclosures hit one specific area, that could definitely change the environment in one area more so than another. My name is Jeb Smith. I'm a real estate broker here in Southern California. And, in today's video, we're going to take a look at that survey from Black Knight. But before we take a look at it, let's talk about a couple of things here with regards to mortgage forbearance. Now, mortgage forbearance ending right now, most of the GSEs, if you will, Fannie Mae, Freddie Mac, as well as FHA and VA, have extended the opportunity for people to apply for mortgage forbearance through the end of June. So currently, if you haven't filed for mortgage forbearance, I believe there's still an opportunity to do it through the end of June, which means that you're going to have people in forbearance through 2022. It's not like all of these are going to end in June and then all of these people at one time have to figure out what's going on. There are still going to be people trickling out of mortgage forbearance, at least for now, through the end of 2022. Now, if that gets extended further, it could take it out even longer, right? So we're just talking about what happens right now and the likelihood of something impacting the housing market in the near future. But let's take a look. We're going to pull up this report here and give us a little bit better information on what's going on. I'm going to highlight some of the things I think are important, the things to keep in mind. Now, we've done these before where we've discussed these numbers and, but each month more comes out and more data is available. But understand, again, these numbers are from January. And since January, mortgage forbearance has been extended for those that needed more time and even for those who hadn't applied. So, the numbers are actually going to be a little bit different than the numbers we're discussing here because you're going to have more people that have extended it, more people actually going into mortgage forbearance than what these report. But these give you a good idea of what's happening when people are coming out, which loans are performing the best versus which are not. And so let's take a look at that report, pull it up here and give you a little bit more information. So I brought this in because, in January, delinquency rates were down 3.82%. The starts, so foreclosure starts were down 17% from a year ago. But you have to understand there's moratoriums on foreclosure. So this is really real numbers based on what's happening in the economy. So I would, not really give those a lot of credit at the moment just because, you can't foreclose on a lot of these properties as we currently sit just because of the moratoriums in place. So, this shows that essentially Hawaii seems to be the worst performing state at the moment. And it talks about primarily due to travel, right? Because of travel restrictions going to Hawaii, they're suffering more than anyone else. And they were actually performing one of the better performing states prior to the pandemic. And now they're actually the worst performing state because of what's going on in the economy there with travel restrictions. Now, I think I believe, I don't just think, I believe that as travel restrictions are lifted, you're going to see more people out traveling, going to Hawaii, going to Nevada, going to, these places where entertainment is very popular. And I think with that, you're going to see, the economy pick up in those areas, because there's a lot of people out there looking to spend money, wanting to travel. And I believe as that happens, these numbers are going to be affected in a positive way. So here we see that Nevada also continues to see an oversized impact at 4.8% of homeowners at least 90 days past due on their mortgage. Now, when we say 90 days past due, that means that they could have been in forbearance for 90 days and just haven't made a mortgage payment for 90 days. So when they talk about delinquent borrowers, they're talking about people that are allowed to miss their payment. So if you didn't need forbearance and you took it anyway, you're still coupled into that delinquent status, right? Because you're in forbearance and you're not making your payment. So the true numbers, aren't actually what they're reporting, and we're going to dive into those in just a moment. So, but to round out that top, you got Alaska, Florida, Maryland, Texas, also some of the worst performers. And California accounts for nearly 200,000 of the nation's total excess number of serious delinquencies. So California, followed by Texas and New York. These are states with very big populations, and probably the large reason that they're on top of that list. Now, the next one talks about loans in forbearance here. So active loans in forbearance is about 2,707,000. If you look here at the report, 903,000 of those are Fannie Mae, Freddie Mac, 1.126 are FHA and VA, and then other is categorized as 678,000. So the large majority of those are FHA and VA loans. And now this talks about shares of mortgages in forbearance with less than 10% equity. So these are people that are, that have less than 10% equity based on their report as of January, and taking mortgage forbearance. And so it shows the dark blue is where they're currently are on their combined loan to value, how much they owe versus what their house is worth. And then you've got with a 12-month deferral is the green, and with that's with just the interest, and 12 months of deferred with the PITI is the blue, right? And then the one here on the right takes it out 18 months. So factoring in home price growth through the third quarter of 2020, just 1 in 10 homeowners in forbearance has less than 10% equity in their home. So 1 out of 10 has less than 10% equity in their home. And they're saying that's typically the least amount that you need in order to sell your real estate and avoid foreclosure. And you can see over here among FHA and VA loans that have higher CLTVs, that's combined loan to values. Overall, the share climbs from 19 to 29%, more than a quarter of struggling borrowers. So after 18 months of deferment, you've got 29% of struggling borrowers have less than 10% equity on their home, according to this report. Now, deferred escrow advances could push the share of homeowners with limited equity even higher to 22 and 36% once you factor in past taxes, etc. Now, this doesn't factor in any future growth, right? So if the market appreciates 7, 8, 10% this year, like it did last year, these numbers are going to be considerably less, right? So we're reading out thinking that, as things stay right now, appreciation doesn't happen. This is where they stand. So again, we're seeing the market appreciate. We're likely going to see home prices go higher, which means those numbers, the number of people with less than 10% equity, should be less in that report. Now, this shows the current status of COVID-19 related forbearances. This is probably the most important chart to me, because it shows what's actually happening with the people in forbearance. Now, you can see that out of the 6.9 million homeowners, 54% of those people are back performing or have paid their mortgage in full through refinance or the sale of their home. So A large majority, right? 61% of people have exited. 54% of those people are performing on their loan, and only 3% remain delinquent and aren't in loss mitigation or some sort of forbearance, right? So 3% have left and not in any sort of loss mitigation or forbearance and delinquent on their loans. That equates to 171,000. So not a lot of people are truly delinquent. So when they say 3 million, they're just talking about people that are behind on their mortgage payments. We don't know if those people can make their mortgage payments or not. Some may be able to, some may not, but 171,000 have exited and are not making their mortgage payments. And out of those, only 64,000 were forbearance failures from mortgages entering the pandemic. So 107,000 of those were actually delinquent on their mortgage prior to the pandemic. So these were people already delinquent prior to the pandemic that fall into that category. Now this chart shows the active number of mortgages out there and how many are delinquent on 30 days, 60 days, and 90 days, how many foreclosures are typically as a result of this, and how many total non-current people there are on their mortgage. So, again, this is where that 3.3 million comes from that we talked about earlier. So 30 days, there's 729,000 people that are only 30 days late, 310,000 that are 60 days late, 2 million people that are over 90 days late. So that means that the majority of these people have been in forbearance for some period of time. And actually, if you go over here and look to the right, the average days delinquent for 90 plus days is 266 days. So that's what, 8-9 months there of people that are, behind on their mortgage. They've been delinquent for, 8-9 months at that point. So that means that they've been in forbearance for some period of time. These aren't people that are just recently delinquent on their mortgage. These are people that have been, delinquent for a considerable amount of time. Now, the real question is, when does forbearance actually end? When will these properties, come to market, if you will? Will lenders actually work with these homeowners in forbearance to allow them to come out of forbearance and continue keeping their homes without any recourse, if you will? And I believe the answer is yes. I believe you'll have a lot of lenders work with homeowners because of the way that this was handled, because it was mandatory by the government, if you will, that that forbearance was applied and allowed to be taken by homeowners without documentation and what have you. I believe that lenders are going to work with them, and I believe they're going to have to work with them because I think it's going to be mandatory. So I think you're going to have a lot less foreclosures as a result of this than a lot of people think. In addition, you've got a lot of stimulus being pumped into the economy right now. You have rental assistance out there to help with, some of the eviction moratoriums and what have you. Now, I do believe you'll see foreclosures as a result of this. I just don't believe it's going to be enough to change the housing market. One thing I've mentioned before, and I haven't talked about it lately, but I believe as more vaccinations roll out, as the economy starts to open up in areas, people are able to go out to restaurants, people are able to go to entertainment, whether it be, baseball, football, sports games, or just go out and watch shows, if you will, in say areas like Nevada and Las Vegas. That is going to put a lot of money in the economy. I personally know a lot of people that are looking to get out and spend money, whether it's through travel or through dining or just get out and about and enjoy life again because they've been on lockdown for an extended period of time. That is going to add a little bit of resurgence, if you will, to the economy. I think things are going to pick up in the economy quicker than a lot of people think. It's going to get people back to work. It's going to give more people opportunities to get their jobs back. Now, that doesn't mean that they're able to come up with all of this money at one time to pay their mortgage. But if they were in a position where they weren't able to pay, this could give them, the lender an opportunity to defer those payments to the back of the loan. Now they're able to pick up and make their mortgage payment where they left off. And, there's no foreclosure as a result of that. Now, again, a lot of this is guessing, if you will, right? Because we truly don't know the impacts. But We do know that there's a lot of money being pumped into the economy to help the economy out. We do know that interest rates can't go too far because there's a lot of debt, right? The government has created a lot of debt out there. 30, 40 trillion is what it's going to end up being, and they have to service that debt, and they service it based on bonds, and so they're going to keep treasury rates low so that the payments on that debt stays low. Otherwise, it would all fall. It would all crumble, and they're not going to allow that to happen, at least for now. So that's my 2 cents on where foreclosures are at the moment, how these forbearances ending will or could affect the housing market. Again, a lot of it's a guess, and I'm not telling you to go out and buy a house or sell a house based on this. It's just my thoughts on the housing market, from somebody that's doing this day in and day out and follows a lot of very smart people who know a lot more than I do. But as I get more information on this, I'll continue to update you. I encourage you to leave comments and questions below. I love reading them, and I appreciate your support. So if you haven't done so, do me a favor, hit that subscribe button. But for now, I appreciate your time. Have a great day. Talk soon. Bye-bye.